In this video, we're going to be discussing mortgage insurance, also known as PMI or private mortgage insurance. Mortgage insurance comes into play anytime you put less than 20% down on a conventional loan. Other types of mortgage products, such as government loans like FHA, also come with mortgage insurance. The key thing to understand is this: mortgage insurance protects the lender, not the borrower, in the event of your default on the loan. It allows lenders to offer lower down payment options while still managing their risk. The most common type is borrower-paid mortgage insurance. This means the insurance is included as part of your total monthly payment. There are also other options, including lender-paid mortgage insurance. Instead of a monthly PMI payment, the lender builds the cost into your interest rate. This results in a higher rate, but no separate PMI line item. Single premium or upfront mortgage insurance means the full cost is paid at closing. Split premium mortgage insurance means a portion is paid up front with a reduced monthly amount. Borrower-paid PMI is by far the most common because it typically offers the lowest interest rate, the lowest upfront cost, and flexibility to remove that PMI later. FHA and USDA loans work differently. Both programs require upfront mortgage insurance and monthly mortgage insurance. The upfront portion is usually financed into the loan, though you can pay it out of pocket if you choose. Unlike conventional PMI, FHA and USDA mortgage insurance is not credit score based. The monthly amount is largely set by the program itself, though FHA does offer slightly lower premiums with higher down payments. In most cases, FHA mortgage insurance lasts for the life of the loan, which is why many borrowers eventually refinance out of FHA into conventional once they qualify. For conventional loans, the cost of mortgage insurance depends mainly on two factors: credit score. Pricing tiers typically change every 20 points. Higher credit scores equals lower PMI. And also down payment amount. Common tiers include 3 to 5% down, 5 to 10% down, 10 to 15% down, and 15 to 20% down. The higher your credit score and down payment, the cheaper your mortgage insurance will be with a conventional loan. This is where conventional loans really shine. Monthly PMI on conventional loans is temporary. Once you reach 80% loan to value or 20% equity in the home, you can contact your mortgage servicer and request that PMI be removed. In some cases, the servicer may require an appraisal, especially if you're requesting removal earlier than your amortization schedule indicates. A few important points. PMI is typically required for at least 2 years unless you refinance or make significant renovations to the property and can document them. Rising home values or extra principal payments can also accelerate PMI removal. A lot of buyers assume they should wait until they have 20% down to avoid mortgage insurance altogether. In reality, PMI is often much cheaper than people expect, especially if you have good credit. If you can secure a comfortable monthly payment with PMI included, and you'd rather keep more cash on hand or buy sooner, putting less than 20% down can be a very smart move. Mortgage insurance isn't throwing money away. It's a tool that allows you to buy sooner, build equity, and keep liquidity. Mortgage insurance isn't something to fear, it's something to understand. Used correctly, it can be a powerful way to get into a home without waiting years to save a massive down payment. If you found this video helpful, make sure to subscribe and check out our other educational content. You can also find us on social media for more straightforward mortgage insights. Thanks so much for watching.